Good afternoon. My name is Matt Smith, and I'm here to present on Warren Buffett's 3G Capital and the buyout of Heinz. So who are the parties involved? There's three different parties involved. There's Berkshire Hathaway, the main player being Warren Buffett. There's 3G Capital, the main player being Jorge Paulo Lemann. And then there's the Heinz Corporation with the CEO being William Johnson. So Heinz was founded in 1869 by Henry J. Heinz. It's a multinational enterprise that offers a product portfolio of condiments, frozen foods, and any other type of consumer food products. In 2012, Heinz did around $11 billion in sales, and their net income was almost $1 billion. As you can see on the screen here, we have a picture of a few of the different Heinz products. So Berkshire Hathaway traditionally was started as a textile business, and then through Warren Buffett, he slowly acquired the company in the 1960s, and he expanded the business into insurance and famously used the float on the insurance company to invest in other companies and acquire other companies. So he's acquired a myriad of different profitable, stable businesses. In 2013, Berkshire Hathaway had $427 billion in assets, and Buffett focuses on simple businesses without debt that generate solid cash flows. And like he says, he really focuses on competitive advantage and margin of safety in the businesses he invests in. So 3G Capital is a private equity firm founded in 2004. It was founded by billionaire Jorge Paulo Lemann. Its biggest and most notable deal was its buyout of Burger King in 2008. So it bought Burger King in 2008 for $3.3 billion, and then led a large-scale restructuring and turnaround of the company when it was private, and then took the company back public with an equity value of $4.8 billion. So it's a typical PE firm where the strategy is to buy undervalued, struggling companies, improve the operations, and sell the company in a relatively short time frame. So what is the negotiation? The negotiation is that 3G Capital approached Berkshire Hathaway and Warren Buffett about a private equity buyout of the Heinz Corporation. The buyout is valued at $23 billion. So what are the key points of the negotiation? There's several main points where Warren Buffett and Berkshire Hathaway do not mesh with 3G Capital. So Buffett prefers not to use debt, yet typical LBO deals are all about debt. So this is a huge problem right here. After the transaction, the proposed transaction, Heinz will have $12 billion in debt on their books. Buffett is a long-term investor, so Buffett buys companies, does not have an exit strategy, and reinvest the dividends into his company to then acquire additional companies. Where 3G Capital is a private equity firm, and the kind of the essence of a private equity firm is to exit the transaction to bring money back to the firm and to shareholders. So Buffett prefers to keep existing management in place of the target companies. So Buffett has purchased a myriad of companies, as I mentioned earlier, and typically the management team stays in place, and that's one of the reasons he buys the assets or the companies, because he believes in the management team. Where 3G believes in bringing a new management team and cutting costs by reducing the number of employees. So in the Heinz example, the current CEO or the past CEO was fired basically during the transaction. So you can see the butting of heads happening already here. And then Buffett prefers to buy underutilized or undervalued assets, where the Heinz buyout is roughly 20 times earnings, the purchase price. So as you can see, this is a pricey transaction as far as Warren Buffett's concerned. Okay, so when and where is this negotiation happening? The deal was announced mid-February 2013. April 11th, the transaction closed. Heinz is headquartered in Pittsburgh. Berkshire Hathaway is headquartered in Omaha, Nebraska, and 3G Capital is headquartered in New York.
So now we are going to talk about the cultural orientation and communication of the two countries involved in this negotiation, and the possible impact of the culture on the negotiation. In this negotiation example, we have two negotiators involved. One is Berkshire Hathaway, which is an American company, and the other one being 3G Capital, which is a Brazilian company. In terms of cultural orientation of an American company, there is a little formalized protocol in negotiation environments. In general, the US negotiators will typically try to get straight down to the business and will do so in whatever manner seems the most appropriate, given their counterparts and the terms being negotiated. To underscore this lack of ceremony and protocol, some US negotiators believe that their overseas counterparts play games in the negotiation process. This is not to say that negotiation techniques are not employed in the US negotiations. Americans commonly use humor in the negotiations to break the ice and try to create a more pleasant environment. Americans are often trained and developed to be prepared when entering a negotiation. As part of preparation, negotiation courses in the States emphasize knowing your ideal and minimally acceptable position before entering a discussion, as well as the projected position of their counterpart. They will typically have done their homework or research before the meeting to be well prepared for the discussion. Normally, Americans will want to get down to business quickly and discuss the issues at hand. Relative to other parts of the world, however, negotiations tend to be completed more quickly due to the limited time spent building a relationship, due to the direct communication style and the fixed time involved in American negotiations. Debates are quite common and acceptable in negotiations in the United States, as long as they remain polite and there is a focus on win-win strategies. In America, conflicts and disagreements are typically dealt with right as they arise and discussed openly, as opposed to waiting until after the negotiation unless they are highly complex and require finesse than is possible at that time. Now we would move on to the cultural orientation of Brazil. As an informal culture, there is little formalized protocol in negotiation environments in Brazil. In general, Brazilian negotiators will not try to get straight down to business and will instead spend a significant amount of time on small talk, getting to know their counterparts and sometimes bringing their foreign counterparts to despair, as it may seem that the conversation is going nowhere. What Brazilians do not bring to the table in terms of planning and preparation, they will compensate for with flexibility and improvisation. Foreign negotiators might be surprised by the apparent lack of preparation of their Brazilian counterparts and their personal and emotional techniques used during a round of negotiation. Brazilian negotiators tend to appeal to sentiments and emotions, which may sound unprofessional for a foreign counterpart. They have a tendency to avoid conflict, especially in face-to-face situations, sometimes postponing the inevitable confrontation until the situation cannot be delayed anymore. Disagreements may not be openly verbalized. This might lead to other parties assuming a superficial and false agreement. By being non-confrontational, Brazilians may overlook some issues and fail to explore all options. Overall, Brazilians are optimistic and positive, and even in a conflict situation, they face it with an attitude that will all work out in the end. In this case of 3G and Berkshire, the influence of culture on negotiation can be treated on a neutral level. What we can see in this negotiation from the cultural perspective is the different approaches to the negotiation based on the cultural orientation of participating companies. Coming from the American culture, Buffett was determined from the very start about the financing aspects of the deal and the duration for which he expects the partnership to exist. This shows his level of preparedness for the JV, whereas 3G was more confused in terms of what primarily it requires from the deal. There were three options to choose from for 3G: time of the deal sustainability, control of the company, and implementation authority of its strategy to make the most from this deal. Even though 3G was the company who approached Berkshire first, they lacked the level of preparedness required to deal with an American company like Berkshire. Berkshire also showed a great deal of interest in the pursuit of the control of the joint venture, which is very typical of the American companies. The operational efficiency culture stems from the culture creating profits through cost reduction and hence puts 3G on an upper level in this negotiation to maximize profits out of this deal.
Hello, I'm Alex Savetian, and I'll be talking about some of the commitment and relationship issues that pertain to this case. Both parties are committed to the deal, so it actually is a favorable deal for all three parties, and it is a friendly buyout. Both Berkshire and 3G are invested in this deal going through because they both see the value add that can be generated. Heinz is currently not struggling financially, but is welcoming the deal as the infusion of capital will give them the money necessary to undertake restructurings that they have identified internally as of 2012. The deal was set at 19% of closing price on February 13th, the day before the transaction was announced, which came out to $72.05. This is a fair price and all parties find it favorable. Therefore, it is not a point of negotiation. The relationships between the three players of the three companies are actually very personal and friendly. Warren Buffett and Jorge Lemon have been friends for years. Jorge brought Berkshire Hathaway into this deal as a partner because he knows Buffett's investment style and strategy and thought it would fit with this buyout. Jorge Lemon learned that William Johnson, the current CEO of Heinz Corporation, was spending his vacation in the same resort town as he was and invited him over to dinner, and that was their first introduction to each other. This encounter turned into their first conversations of the acquisition. So all three men have currently very friendly relationships. And these relationships on a friendly base, which makes the negotiation easier as the counterparties trust each other more if they were not acquainted. The relationship should move, as this negotiation proceeds, to a more professional relationship and have all three key players work together and be unbiased in their decision making. And closing this gap should not be a problem. Time and working together will be able to close this gap. Berkshire Hathaway and 3G both have the same power in this negotiation, in the terms that both can walk away from the deal. In order for this deal to go through, they need 3G's operational excellence, and they also need the financial backing of Berkshire Hathaway. So therefore, this negotiation will be mutually beneficial to both parties. They're almost on equal playing fields. However, 3G actually initiated this acquisition and brought Berkshire Hathaway on as an invited partner. Therefore, 3G has the opportunity to go out and find another partner if Berkshire Hathaway does not agree to this deal.
Hello, my name is Wenjie, and I'm going to talk about interest and goal setting during this negotiation. I categorize the goals and interests into three sections. The first one will be decision making and control. The second one will be top management and staffing. The third one will be exit of the partnership. First, interest for decision making and control. For Berkshire, they prefer to develop a long-term partnership with both 3G and Heinz. They are willing to put more capital for the buyout and not involved in the management and operation. However, for 3G, their strategy is more focused on value-added process for Heinz, and eventually they want to sell for a premium price. Compared with Berkshire, they are willing to put less capital for the buyout, but they would like to take the management of the daily operation and increase the efficiency for the whole process. Similar to the interests, they have respective goals for the decision-making process. For Berkshire, they are willing to take equal control of with 50% votes between Berkshire and 3G. And this is same thing for 3G. That's the mutual goals for the equal control part. In terms of capital, Berkshire is willing to put more capital to not only for the common stocks but also for the preferred stock. Well, for 3G, they are only gonna put less than $5 billion for the common stocks. The next one will be top management and staffing. For Berkshire, they want to keep the CEO and continue the good performance for the Heinz. However, for 3G, they want to increase the efficiency for the Heinz for further production and further operation. In this regard, they would like to change the CEO and replace it with 3G's new management team. For Berkshire, their interest will be they want to have a strong say in the management team. However, for 3G, as they want to increase the value for Heinz and eventually sell it out, they are more focused on they want to obtain the fully controlled management and the starving. During the negotiation, their goals are totally different. For this part, Berkshire want to keep the CEO while 3G is fighting for replacing the CEO. And 3G is also want to take off the fully in charge of the staffing, while Berkshire want to have a say in that part. Their major conflicts will be in the top management level for the staffing part. The next one will be the exit of the partnership. For the interest of the exit of partnership, Berkshire would like to develop a long-term relationship. Berkshire, as under controlled by Warren Buffett, he is totally against the of buyout and resell within 5 years, just to obtain the short-term profit. However, that's the typical goal and strategy for 3G. Similar to Burger King case, 3G would like to add value to Heinz and sell it out within 4 years. This different interests created the conflict between Berkshire and 3G. As they have different interests, the goals for the exit of the partnerships are totally different. Berkshire would like to ask 3G not existing the partnership unless Berkshire agrees. However, 3G would like to free entrance and the exit of the partnership as long as they can find the buyer for Heinz for their common stocks.
Hi, this is Indraneel Samant, and I'll be taking you through the BATNA for both the parties involved. First, let's have a look at the rationale for Berkshire Hathaway when they think of a BATNA. There are two things here. First is Berkshire Hathaway is looking for a major acquisition in 2013 to boost the company's stock performance. Also, Berkshire Hathaway looks for an investment that can give a long-term impact on their profitability and the growth, which is basically their business strategy. So based on these two factors, the ideal BATNA for Berkshire Hathaway would be relinquish interest in Heinz and look for another major acquisition which satisfies the two criteria mentioned in the rationale. Now let's look at the rationale for 3G Capital when they think of BATNA. There are three things to be considered here. First, though Heinz is not doing as bad as Burger King was, 3G is purely interested in a short-term involvement, which is again their business strategy. Unlike Berkshire Hathaway, they would want to reshuffle the management and the operations to increase internal profitability. And the third one, 3G approached Heinz first. That gives them an advantage to create their BATNA. So based on these 3 points, we can say that we can conclude the BATNA for 3G Capital, which is 3G Capital can approach other investment companies that are more aligned to 3G's business strategy to acquire Heinz. And yep, that's it. So finally, I'd like to thank you, Professor, on behalf of the team. Thanks for your